Hello, everyone. Good morning, good afternoon, good evening, as Asian Lee would like to say, wherever you are. Uh, I've been waiting for a long time to get into some sector rotation analysis, and I can't think of anybody better to do it with than Socrates. It's really an institutional technique, and I'll explain it in a little bit and go into how it's used as a way of balancing a portfolio in an attempt on a relative basis to outperform an index. But it can also be used absolutely, and we'll go into both of those things. But for now, Socrates, how are you doing?
Hello, Tyler. I am doing excellent today. I appreciate you having me on. I'm going to be very much looking forward to this episode. I will probably be more of a student than a co-commentator today. I think that the sector rotations is an extremely important concept, and that it is an area that Tyler has a lot of experience in and has a lot that he can teach us. And just from a personal perspective, it's something that has always made a lot of sense to me, in the sense that people will tell you how everyone makes money in a bull market, and then you can extrapolate and say, well, there's almost always a bull market somewhere. So if it's easy for most people to make money in bull markets by buying and going long, and there's always a bull market in some sector somewhere, then it just makes a lot of sense to have your money in the sectors while they're bullish, and then to rotate out while they turn bearish. And that's something that I came to the conclusion of pretty easily in 2018. We just had the huge run in Bitcoin, and I had spent the large majority of my time and energy focusing on Bitcoin and altcoins. And then in 2018, as that party started to come to an end, I realized that it's probably time to take a look at some of the other sectors in the world that are still experiencing large bull markets, and move my time and energy there while Bitcoin it gets a chance to go through its market cycle and its bear turn. So that's my thoughts and my minimal sort of experience and perspective. So I will be very excited to hear what Tyler's got for us today.
Well, great. Thank you very much. Let me just start by explaining what the term sector rotation means. I'm sure everybody can kind of picture it, but it's really it's more detailed than that. Every index is broken up into a number of subgroups, but the biggest of the subgroups is called a sector. In the S&P 500, for years and years and years, there were 10 sectors. Today we've got 11 sectors. We've renamed one, and we've added another one just in the recent past. As you'll see on one of the charts, there's very little data on the newest sector, and we'll get into that. It doesn't really matter so much. I just want conceptually people to understand what this is all about. Let's assume you just buy the S&P 500 index, Vanguard, or any of the ETFs or the S&P indexes you can buy very cheaply. Usually you don't pay more than 10 basis points per year on the expense ratio of that kind of a fund. So it's very cheap. You don't pay a transaction cost to get in. You don't pay a transaction cost to get out unless you're buying an ETF. And then you do pay a little bit at Fidelity. It's like $4.99, even if you've got $1 million worth of this stuff. Really cheap. Okay, why do you do that? You buy the S&P 500 because you believe, after looking at fundamental and technical things, that it's in an uptrend, which it has been for the last 10 years. And that way you don't have to try to pick 10 or 20 or 30 or 40 different stocks. And if you don't have a lot of time, what you're going to do is you're going to be right on 10 of those big time. you're going to be wrong on 10 of those big time, and the other 20 are basically going to be doing what the S&P 500 does. So why did you waste all that time and effort and commissions getting in and out and tracking all these individual stocks when basically it's only going to move with the S&P 500? You could do it with just one purchase and just watch that purchase closely. There used to be ads on television where they said, put all your eggs in one basket and just watch the basket very carefully. And there's a lot of truth to that, getting away from diversification. I don't ever like to do that for one thing like Bitcoin or for one thing like Google stock. But when you do it for one thing like the S&P 500, you own 500 companies. Okay, so that's why people buy indexes. They're very inexpensive. They're very easy. You can look at them once a month if you want to. But if you're correct on the trend, you can ride that trend for a very long time. That doesn't work in institutional investing. Institutional investing, which I did for 2 or 3 decades, means that I am competing against 2 things. One is the index itself, because there's no reason for a big institutional pension fund to pay me if all I'm going to do is match the index, because they could buy the index and not have to pay a manager any fee. Therefore, a manager has got to come up with a way that they can add value over and above their management fee. And on big institutional accounts, the management fee is about 35 basis points. On smaller accounts, individual accounts, it's about 1% per year. But on very large institutional accounts, and I'm talking about 10 million, 20 million, 50 million, 100 million. The biggest single account I ever managed was $475 million. When you go to get that account, you are competing against 1,000 other managers. And so you've got to have a good story. You've got to have a good track record in the past. And they look at all that stuff. And then you've got to stick to the story in terms of how it is you're going to manage the money. One way of doing it is called sector rotation. And when I joined the firm that I did back in 1991 called Amivest Capital Management, the chief investment officer there was a brilliant sector rotator. He had come from one of the biggest trust companies in the United States as their head of research. And he came over to be the chief investment officer at Amivest Capital Management. I came on as the senior portfolio manager, and I really didn't know very much about sector rotation. So it took me 3 or 4 years to understand what he was doing and why he was doing it. And here's the way it works. I've got to beat the S&P 500. Basically, they give you 2 or 3 years to do it. So you can lag for a quarter or 2, but then you get nasty notices from the pension consultant and the trustees and the lawyers saying, you're lagging, you better get your act together. Otherwise, we might have to cut the amount of money we've got with you or change managers altogether. So that's the constant pressure that an institutional manager is up against. Now, most managers are stock pickers. And what they try to do is put together a portfolio of stocks that beats the S&P. And very, very few of them can do it all the time. Most of them can do it in a weak market, and almost none of them can do it in a strong market. There's a small handful, less than 5% of all great money managers that are stock pickers that consistently can beat the index in both up and down markets. Now, why is that? For the simple reason that the guidelines of big institutions don't let you short the market. So in a down market, by definition, the S&P 500, which is your target, is going to drop exactly the amount that the S&P 500 drops. So if you buy an index fund and you hold on to that index fund and the market's down 25%, you're going to be down 25%. And guess what? You match the index. So that's a very safe way of doing things. If on the way down you raise the maximum amount of equity, cash that they let you raise, and that usually varies between 5 and 10%. Let's just call it 10%. And the market's down 25%, you're going to beat the index by 2.5 percentage points. You're still going to be down 22.5%. You're still going to have lost millions of dollars, but you can't do anything about it because that's what the guidelines say. Therefore, what happens is very few money managers have trouble beating the index in a down market. But their absolute returns are terrible. But that's the best that can be done under the circumstances. Now, in an up market, 75% of all stock pickers or investment managers underperform the index. It is very difficult to outperform the index in an up market. Why? Because the index is not a real thing. It's a construction, and it has no slippage. It doesn't cost anything. The index itself, when the S&P 500 is up 25.213%, that index is up 25.213%. Whereas in real life, a manager has got to buy a security, sell a security, and charge a management fee. And because of that, in an up market, you've got to overcome all the things that an index doesn't have to overcome. All right, enough of that. There is a technique called sector rotation, which is a brilliant way of being able to beat the market all the time, if you're good at sector rotation. And let's just think for a second about what that means. If the S&P 500 is an uptrend for the last 2 or 3 or 4 years, by definition, at least half of all the sectors are going to be positive. And probably all of them, those half, and we'll call it 5 or 6 of them, will be up more than the index itself, which also means that 4 or 5 are going to be up less than the index. So all you've got to do is pick the 1 or 2 sectors that are doing better than the S&P index itself and buy less of the 1 or 2 that are doing worse, and you will always beat the S&P 500 index. Now, for you and me, for individuals, we don't care about that. We are all really absolute return oriented. We don't want to lose money when the market goes down, or Bitcoin goes down, or gold goes down. So what we do is we sell it and we get into cash in most cases. What we want to do is we want to always make a little bit of money. We don't really care if the S&P is up 20% and we're up 17%. That's a great return. But it gets you fired as an institutional manager. You can't lag the index like that. Okay, that's what sector rotation means. It means you look at all 11 sectors in your index. You analyze each of those sectors absolutely. Are they doing well or poorly? But you also look at what are they doing relative to each of the other sectors in the index as a whole. And you want to overweight a couple of them, underweight them, and be on the other ones. Okay, what do I mean by right on the index? Well, we all assume when you don't know a lot about sectors in an index that if there's 10 sectors, they have all 10% of the index. Wrong. Each sector has its own weighting in the index relative to the stocks that are in that sector relative to the index. For example, right now, out of the 11 sectors, the biggest one and everybody can pretty much guess what it is technology. The technology sector is 20.84% of the index. It's 1/5 of the index, even though it's only 1/11th of all of the sectors. The next biggest one is half as big, almost. Well, 25% less. It's healthcare, and that is 14.9% of the index. Financials are 13.7%, and consumer discretionary is 10%. But you've got 3 sectors that are less than 3% of the index each: materials, real estate, and utilities. Now, everybody's excited that utilities are doing really well. In fact, it's the best performing sector over the last 18 months. It only makes up 2.82%, 2.9%, or 2.8% of the S&P. So even if you double the size of the S&P, double the size of your utilities holdings, that only brings you up to 5.6%. That's only 1/4 of technology. So you cannot equally weight these things. You've got to weight them in your portfolio the way the S&P is weighted. Otherwise, you are way overweighting some things, way underweighting some things, and then sector rotation doesn't make any difference. Okay, what we're going to do today, that took longer than I wanted it to, but I just want everybody to understand the difference between absolute return, which means that's what many hedge funds try to do. They don't try to beat any index. They could care less about indexes. I don't care at all about indexes. I did when I was an institutional money manager. All I care about is what's called absolute return, which means greater than 0. You don't want a year to go by where you have returns that aren't at least 0 or above. No negative returns, but you don't worry about the fact that the S&P is up 10% or 20% or 30%. You just don't want negative returns. That's what absolute returns means. And absolutely, when markets are weak, you don't want any negative returns. So everything you do is to try to control risk. Why? Because reward will always take care of itself. If you're in an uptrend, forget about who is beating you, what indexes are beating you, what some manager at Fidelity is doing. None of that matters. You will make money if you've got the trend right and you are in the market. The amount you make is under your control. You can take more risk in the market or less risk, but the important thing is the difference between relative returns, which is what all institutional managers are about, and absolute return, which is what every one of you and myself and all of my fiduciary clients are concerned with. They don't want to lose money. They want to continuously add to what they already have. Okay, I'm going to do a screen share, and we're going to look at all 11 sectors of the S&P. And as we do it, I'll tell you how big they all are. But what Socrates and I are going to look at is all the fundamentals and all the technicals, just like we do on anything else. When we talk about the S&P, we look at stop and reverse points and where the trend is and where Consensio is, and is it in a hyperwave, and what's the sequential doing, what's the RSI doing. You do the same thing for each sector, just as you would for an individual stock or for Bitcoin. Okay, with all of that, let us go to screen share, and I'll go here and here and here and share it. Get rid of this, bring this up. And this is, we're going to start with, we will start with the biggest one, which is the XLK. The XLK is the Select Sector Spider Technology Select Sector. XLK. This is the largest of all the sectors. There's 20.84% in when I last looked. Every minute that changes. Why? Because if this sector is doing slightly better than the S&P or slightly better than the other sectors, it will take a bigger weighting that day, that hour, that week, that month that it is outperforming. If it is underperforming, that 20.84 will drop. So it's constantly in motion, but as we sit here today, it's about 20.9%. So this is one of the biggest sectors, and we've looked at it in a number of ways by looking at the FANG stocks and looking at different things, but this is the full sector of the S&P 500. And what you see here is very similar to the S&P. We've got this big pattern where we go up, we come down, we go up into last September, hit a new high, we go all the way back to lower lows, and then all the way up to higher highs. Anyone watching Socrates and I over the last several of our vlogs know that this is also called a Selgin 5 topping pattern or a broadening pattern. And it has been coming down for the last 5 weeks until the big week we had last week, and it's actually added to it so far this week, and we're on a green 2 above a green 1, and we have just taken out the stop and reverse point. Okay, so the biggest sector is doing very well and is very close to being able to break out to the upside, just the way the S&P 500 is. And that's what you would assume, since this sector has been one of the driving forces of the S&P and makes up 1/5 of the entire S&P. So you would assume that they would be acting fairly similarly, and they are, and therefore all of their technicals are very similar. We had a 9 sell here on sequential that was quickly reversed with a green 2 above a green 1. The green 1 went above the 9, and then we got up to a 7 before we headed back down again. We did have a 13, C13 sell signal on the green 6, but we've come down. Notice that we're holding the Consensio uptrend on the 30-week moving average, which turned from down to up just about this time this 9 was hitting, but is now in an accelerating fashion with all of these bars above it. And last week, we wicked right down to it, bounced very strongly off of it. In fact, we went all the way up above the intermediate term moving average on the end of last week's close. A closer look shows you that the intermediate term is still moving down, but as soon as it turns up, we've got a 100% Consensio bull market. The problem is we've also got here a 5. I didn't check to see if it's actually a 7, but let's just call it a 5 for now, broadening top. And those of you that have listened know that on a Selgin top, you go out 5 weeks, which would be 1, 2, 3, 4, 5, before you start bringing the stops down. And you can just picture that the stops are still above this 2, but it's not going to take much upside action to negate this 5 and break through to the upside. So I will just pause here for a second to see if Socrates has any comments about this chart of the technology sector itself.
I just say that that looks like a very bullish setup to me, and looks like it could be providing some interesting entries based on the pullback to the long-term moving average, which had recently reversed and had started to turn bullish. And then now we're getting the short-term crossing the medium-term moving average. The medium-term should start to flatten out if it hasn't already. Along with that, we've got a broken weekly parabolic SAR. I went into detail yesterday about how important that is to me, specifically on the weekly time frame. And we've also got a green 2 above a green 1. So basically every indicator on the chart right now is signaling potential entry, and that's something that I really like seeing, is multiple indicators lining up and pointing towards the same thing. So a question for you is, if I'm looking at this chart and I'm really interested in longing here, would you personally be looking at longing XLK, this ticker and this chart, or would you want to yourself look into individual stocks in the technology sector and focus on those opposed to like an ETF type of thing?
Well, that's a great question. Getting into the money management side of things, as a sector rotator, we were the only sector rotators that only used mutual funds, ETFs, and indexes. We didn't buy individual stocks. Most sector rotators do what I just described with their sectors, but then they go in and they buy the stocks that are leading those sectors from a momentum point of view, or if they're a value investor, they'll buy the best value stocks in that sector that have not yet moved but have more intrinsic value. So what I'm doing right now with clients, because I can do both, I don't have any restrictions. I can raise cash, I can hedge with inverse funds, is I have come up with a way where 60% of a portfolio is in large indexes or mutual funds or ETFs, and 25% are in sectors. And the 25% in sectors, this would be one that I would want in that 25%. And I don't need to buy much of it because I've already owned it in the 60% of the portfolio that is already the S&P 500 and or the Dow and or the NASDAQ or some combination of those. So I'm already fully loaded, matching 60% against whatever the market wants to give us. So I could buy a little bit of this, say 5% extra, to add to what's already in the technology that I own in the big funds or the indexes. And now what I've done is I've just supercharged my potential returns, as all, if I'm correct in that this trend is going from a short-term downtrend back into an intermediate or a long-term uptrend. So you still have to do all your analytics on each of the sectors just the way you would on the overall market. If you want to really supercharge it, you pick the best and strongest sectors, you put those into the 25%, but then I leave 15% for individual stocks. So now you go into the sectors that you really like, and maybe some you don't like, but you particularly like the individual stocks, and you've got 15% of the portfolio where you could buy 3 stocks at 5% each. And if they're up 20 or 30 or 40% more than the sector itself or more than the index, you're going to get great returns, which is another way, if you're interested in beating your brother-in-law or beating your next door neighbor, or beating an index for whatever reason you want to beat an index, that's the way to do it. By incrementally getting more risky with less and less money, because then it protects the corpus of your portfolio. So that's the way I would look at it.
Excellent answer. Great. Fantastic information.
Okay, great. We're going to jump down to the next biggest one. That was technology, 20.1% of the index. Number 2 is healthcare, and that is the XLV. The XLV is the Select Sector Spider Trust Healthcare. And what you see there is it is not as strong as technology. It makes up 15%, 15% of the overall S&P 500. And you get a different picture here. And the different picture is that on this run up from December in the S&P and in the technology, we went to new highs. This one did not go to new highs. It went up, but then it rolled over and went more than 50% down relative to the up since December before it began to stabilize and now has turned up. But notice a number of things. One, we're still well below these tops. We are in a descending pattern, but we're challenging it right now. We have just come up to the stop and reverse point on this wick this week, but we did not pierce it. So it is still negative, the stop and reverse point. And then taking a closer look at the Consensio situation, you can tell it's very much different than what we just looked at in technology. It's basically completely flat, with each of the 3 moving averages, the 37 and 2, cutting back and forth between each other. That's a trendless market. You get up to a 7, and then you drop down to a 4, then a price flip, then down to a 5 and a price flip, up to a 2 and a price flip, a 1 and a 2. Theoretically, we've got a green 2 above a green 1, but not with very much emphasis at this point. So just a quick look at healthcare tells you this is not one that is beating the S&P. You probably want not to be in this unless you see the S&P and the stronger sectors breaking out to the upside. Why would you be in this if what you're looking for is a long-term trend, which is what I'm always looking for as an investor? On the other hand, if you think this is going to catch up for fundamental reasons to the stronger parts of the S&P or the S&P itself, it might be considered undervalued. And if you're a value investor, you might be looking at it. So the number 2, healthcare, is not helping the index go up. It is actually a drag on the index. And you want to, if you have 60% of your account in the S&P 500, you don't want to add this to what you already own in healthcare in the S&P 500. It's not going to help you relative to the index. Any comments on this one?
Just a brief comment that you might notice similar looking signals that might be on the horizon. As we saw with technology, we're challenging the weekly SAR. We've got a green 2 above a green 1, and we are, it looks like, getting ready for a crossover with the medium and the long-term moving average. So it may look like it will be providing some of the same signals that we saw in technology. But I would disagree with that because of the angle of the long-term moving average. We can see that the best case scenario we could give it is that it's been flat, and the worst case scenario we could say it rolled over in March and went from moving up to now starting to move down. Now, that may not seem like much, but it is actually extremely significant. And is more important to me than any of the other signals. And what does a flat moving average tell you? It tells you that there's not a trend, that you're in a ranging market. And if you're trying to use these moving averages and TD sequential to capitalize on price movement, you need it to almost certainly be a trend. You're almost certainly not going to be looking to trade a range by the tools that we are showing you. So if it is indicating that you are in a range by having a flat moving average, a long-term moving average, then that's something I really want to kind of stay away from and wait for a break of the market structure. So even if we do break that weekly parabolic SAR and get the crossover with the medium and the long term, I would still want to see this thing break above like 95 or 96, get out of this range. Yeah, maybe, yeah, 96, I would say. Get out of this range that it's been trapped in. And at that point, it would be interesting to take any signals that come along. So just wanted to kind of point out how important the angle of that long-term moving average is, even when you are getting a confluence of other signals.
Terrific. That's a great observation. I agree with it completely. And that's the way I would be playing it on both at an institutional level, relatively, but also absolutely. You don't want to tie money up in something that is struggling to find direction if you've got other opportunities that have already showing a direction, which we clearly did with the first one, the technology. Okay, let's move on to number 3, which is the financials. Now, there was a long time that the financials made up 35% of the S&P 500. When was that? That was prior to 2007, 8, and 9. And they've been crushed ever since. Many banks have gone out of business. The net interest margin on banks has fallen to almost nothing until recently, when Powell and others began increasing rates that give the bank a spread with which they can make money. But this, at one time, for very many years, was by far the single biggest, much bigger than technology, well over 34-35% of the entire S&P 500. Today, it is 13% of the S&P 500. So it's still substantial compared to, there's 11 altogether. Having 13% means that you're bigger than the average by a fairly good margin, but much, much smaller than it used to be. Now, if you take a look at the chart, you find a number of interesting things. Number one, the run up from 2017 to 2018 was the high. The other things we looked at went to higher highs, like the S&P right here in September of 2018, and some of them have gone to higher highs still recently, like technology and like the S&P 500 and the NASDAQ indexes. This one has got highs below highs, highs below highs, and of course, lows below lows, below lows, below lows. Now, we do have here higher lows than these lows, and higher highs than these highs. So we've got an intermediate term trend going on, but the big picture is nowhere near what the first technology or the second healthcare looked like. Also, going back, I'm going to take the price off so you can just get a quick look at the Consensio And you can see the long-term moving average peaking back in June, summer of 2018, and going down ever since. Now, on this last pull-up, it's kind of turning and then flattening out again. The moving averages are trying to get going, and just recently the short term is cutting through the intermediate term, and back here the intermediate term did cut back above the long term. So something is happening here, and you can read about it in Barron's or IBD or see in CNBC. 50% approximately of the people that are talking about it think it's got a bottom in and it's going higher. But plenty of people still doubt it because of what's going on with short-term, intermediate, and long-term interest rates, and that we've got some inversions in the interest rates, and the financial sector is dependent on net interest margin, what they can borrow from the Federal Reserve System and what they can lend. And if mortgage rates are dropping and all the other rates are dropping, it gets more and more difficult for banks to make money. Now, this is not just banks. This is also brokerage firms. It's insurance companies. They're all sensitive to interest rates to one degree or another, but the banks are the most sensitive, particularly regional banks that can't do other things. They just basically do home loans and mortgages and lines of credit and sometimes credit cards. Okay, so net, we have come right back up to the stop and reverse point. Did not break it yet, but we came right up to it before getting, and I love the way Socrates talked about it in the last couple of vlogs we did, where it's amazing the way this stop and reverse point, look at this coming down to it, wicking right down within, pennies, and then shooting back up. In this case, we came right up to it within pennies of the stop and reverse point, and then got clobbered and got turned down from it. But it's trying, the price is trying to hold above the short and the intermediate term. The long term is not really helping, other than notice that even though we broke it here on a weekly closing basis, it responded, as it tends to do, by shooting the price back up off of it. Also notice that here it struggled to get through it from the downside, did get above it, got knocked down, did get above it, got knocked down big time, struggled to get back to it. Finally, we got above it, and we've been above it since. But notice over and over again the way that long-term 30-week moving average has been great support and resistance. It looks like support now. It looks like things are happening with the short and intermediate term, but it is the weakest of the three that we've seen, even though it's the third largest at 15% approximately. Any comments on this one?
Yeah, I think that this is a very important chart, and I am not thinking that it should, I'm not seeing much that tells me that it should continue upward, despite seeing this recent cross with the short and the medium term and the support from the long term. I am really just looking at this as lower highs after lower highs. And in the stock market, like the S&P, we've got the broadening pattern, which is it had higher highs and then lower lows. This is kind of looking similar, but it has lower highs across the board. So this is looking much more bearish to me than anything else. And knowing what we know about the fundamentals of the financial sector, it could very likely be the what leads the way on if the next correction does happen. It would make sense that the financial sector leads the way. It has been the weakest. It's been, its recovery hasn't been near as strong, and it still has a lot of issues, like mentioned, the interest rates are at the top of the list, and the balance sheets are right there with it. So this is something to me that is very interesting and very important, seeing the stock market and other sectors looking like they're finding support and trying to move forward, and then seeing this one starting to look really like it's going in the other direction, to my eye, is something that's really important. And the last thing I'd say is, if you just zoom out for about a 10-year, look at the last 10-year cycle, ever since they bottomed in about 2009, they have created a trend line that has been acting as support over the past 10 years or so. So that's the trend, the rate at which this sector has been progressing since it found bottom in 2009 is right there on that trend line that Tyler just drew. So that's a very, very important boundary for me. If that threshold breaks down, then I would be very confident that this has topped. Right now, I'm not very confident. I'm just kind of leaning that way based on the lower highs, and also what's jumping out at me is how the lower lows are at an increasing rate. Each lower low is progressed more than the prior one. So there's a number of things there that make me think at a minimum we should come to retest this trend line before going any higher. I would really expect a retest of that trend line around 22 or so. And if that holds, then that would be very significant. If that breaks, that would be a hugely important indicator to me. And I'm going to be setting an alert on that trend line right now so that I will be aware if that does happen. So that's what I've got for you there.
Very, very good. I noticed a couple of other things. Notice that the highs that we reached in 2018 are almost exactly the same as the highs all the way back 10 years ago. And I'll just quickly pull up the ones we just looked at so you can see the same thing over the same time period. Number one, the XLKs, the technology. Look at the difference between 10 years ago right here. Those were the highs in technology before the big downturn in 2008. Look where we are today. And if you take a look at healthcare and financials, the healthcare, the XLVs over the same time period, those were the highs. And look where we've gone. Compared to what we just saw in the financials, now you know why the financials dropped from 34% of the total S&P down to 13%. And then finally, the financials, I'll just bring them up again, because we've got this double top. We've only gained over 10 years what we lost in 2007, 8, and 9. Now, that also means they could very well be greatly undervalued relative to the rest of the market. And I point out one thing here, which is I always look for broadening bottoms and broadening tops. This is a broadening bottom, and it worked perfectly to run us from 22 bucks up to 28 bucks or $6 on 22, or something on the order of 25 to 30%. This is a 5 bottom, this is a 4, this is your 3, this is your 2, and this is your 1. So you've got a 1, 2, 3, 4, 5, and your stops are below this point for 5 weeks, and then they start up. I haven't drawn where they are. We could have taken them out here. You can all do that work yourself, because we've got a lot more to talk about. But the point is that even in the weakest scenarios, this relative to the S&P or the other sectors, you can find opportunities using other technical tools. And you could either get out when the stop and reverse was taken out up here, or you could wait for the Selgin stop and reverse themselves to get out. we still are in a downtrend from the top because we haven't gotten through this stop and reverse point. So a lot of ways to look at all these. I'm going to move to number 4, which is the consumer discretionary, the XLYs. Right here. Interesting. It immediately pops out. You can see the difference between the banks and the flatter ones that we've looked at, like the healthcare. Here we've got highs above highs above highs in the consumer discretionary. Here you clearly see the long-term moving up. You clearly see the short-term cutting through the intermediate term, but the intermediate term is still moving down because we had this 8 going into a potential 9, and then we had a pullback. Of course, we found support right at the long-term moving average on the 30-week, and now we've moved up sharply from that, and we've got a price flip. So all in all, this looks almost as good as technology, not quite, but almost as good as technology. It makes up 10%, 10.16% of the S&P. So out of 11 things, it's basically got its equal share, just dividing the 10 into 10% pieces, or the 11. It's got slightly more in terms of its weighting, and it's looking fairly bullish, just looking real close. We've got a clear 5, 4, 3, 2, 1. So the reason I am in general not 100% into the S&P is because we're sitting on broadening tops on a number of the strongest of the sectors that we're looking at, besides the same thing with the S&P and the NASDAQ. So that just makes me cautious, and I'm using Consensio to raise cash as we came down. And now what I'm considering is, at what point do I want to put that cash back to work? We've already seen 3 sectors that I can put it to work in, but it also means putting the cash back into the S&Ps and the NASDAQ when I make that call. Anything you want to say about consumer discretionary?
Nope, nothing. I would agree that it's looking almost as bullish as technology, but not quite.
Okay, great. We'll move on to number 5. Number 5 is communication services, which used to be called telecommunications. But then they add the telecom in with basically the symbol, by the way, is XLC. They added telecom in with the rest of communication services just back here in the summer of 2018. So this is a new sector. It already makes up 9.93%, 10%, because it's got all the big, huge telecoms in it. So we don't have much of a story here on a weekly basis. It's been flat kind of completely along. You can see the long-term moving average completely flat. Prices have gotten back above it after turning down. We had a red 9 here that didn't do anything. We've got a red 9 here. It did get at least a 1 to 4 week pullback. And now we've got 2 green candles, but we need to get a little bit higher to get a price flip. It looks completely neutral to me, even though it makes up 10% of the index. In terms of our stop and reverse points, they are negative after this 9. And to me, I wouldn't touch it. I don't have enough information. I could go into the individual industries. You might find something different, but it is basically not helping or hurting you from a weighting point of view. And the fact, though, that we had gotten back up here to about the same level we were back at the September highs of the S&P 500 and the September highs before this sell-off. The sell-off wasn't all that great relative to the S&P and to some of the other sectors. So even though this is a short time frame and things look flat, they're mainly looking flat because we don't have the history. But when I look at it a little bit more closely and see that we've regained everything that we lost from the September highs, and let's just quickly pull up the technology, the XLKs, so we can see the difference. The technology got higher than this level. The XLYs, which were the consumer discretionary, got higher than this level. The S&P got higher than this level, but things like healthcare, the XLVs, did not. So even though this one we're looking at now, communication service XLC, doesn't have a lot of information, what information it can give us is actually pretty bullish. The ability to completely gain back what was lost in the big sell-off in the stock market, we got up there. The financials, the XLFs, did not, and did not even make it back to these highs. So neutral to positive, I would say, on the XLCs. Anything on those?
Nothing, except I would just say we are at an hour. We may have to break this down into 2 episodes if we've still got 6 sectors to go. What do you think?
Yeah, let's do this. We've done the first 5. Let's throw in number 6, the industrials, and then we'll call it a day, and we'll come back tomorrow and do the rest of them.
All right.
And any comments and questions people have from this one, will please send them in through the chat, or if you're in our Telegram, send them to us, and we will have time to answer those tomorrow. So number 6 is the industrials, one of the more important of all of them, all of the sectors, the XLIs, and they make up 10%. So they're a pretty large group compared to the real small ones like materials, real estate, and utilities, which are only 2 or 3%, or consumer staples and energy, which are only 6%. Those last 5 I just mentioned will be the ones we'll look at tomorrow. They're the smaller ones. They also tend to be very, very volatile. What we see very quickly here are highs below highs below highs, but not by much. We see a very nice bounce off the bottom, a 9 sell that didn't go anywhere, and we quickly got above that high. That's a positive. We came right up to the stop and reverse point like we did on 3 other occasions on the sectors we've looked at. We've got the short term cutting above the intermediate term, which is moving down like 3 other sectors we've looked at. And we've got basically a long-term moving average that, because we went so low and this high was lower than this high, rolled over in the summer of last year, slowly went down, dropped sharply, slowly flattened out, and now appears to have turned up. So net, this one is looking pretty good to me. Not as good as 2 of them we've looked at, but it wouldn't take much to break through the stop and reverse points, turn the intermediate up, and be in a fully bullish posture. And it does not have to go very high to take out the all-time highs relative to the wilder ones that we've looked at. Any comments on this one?
Not really. Seeing that the moving average is starting to turn up is definitely interesting. This would be a situation where I would again want to wait for a break of the market structure, give me a higher high above 77.50 or so, and then I would be interested in buying the following pullback. As it stands right now, I would be mostly expecting a range. Seeing that barely starting to turn up is it's intriguing, but it's not enough for me to think that we're going to make it out of this sideways action. So I would be waiting for a little bit further confirmation before getting interested there.
Terrific. That's great. Well, we made it through a little more than half of them. We gave you about 15 minutes worth of finance philosophy in terms of absolute versus relative, and a little bit of information about what sector rotation is all about. I like Socrates' question in terms of when you find a really strong sector, why not look at individual stocks? And that makes a lot of sense. It gives you a hint where to look without having to just go through 500 stocks in the S&P 500. Pick out the 3 strongest on a momentum basis sectors, and then if you happen to find 4 or 5 or 6 interesting stocks in each of those sectors, and you can get the stock breakdown of each sector just by Googling it. It's real simple stuff. That makes a lot of sense. So with all of that, thank you all very much for listening. Socrates, thanks for all of your comments. Great.
Before we hop off, everybody's wanting us to take a quick look at Bitcoin, so I could pull up that 4-hour.
Absolutely.
Absolutely.
I was back in my institutional mode.
Sorry. Yep, no worries at all. That was a great presentation. I certainly really appreciated it and learned quite a bit. So just taking a quick look here at the Bitcoin chart. Yesterday, the price was on this candle right in here, and I had said that what I wanted to see was a pullback to retest what was a confluence of support in the like 80-20 to 80-50 area, and that confluence was coming from this horizontal area that it was resistance, and I was expecting that to become support. Was also looking at a potential parallel channel that saw the price wicking off from right here, and thought that a pullback to retest the bottom of this channel would make a lot of sense. And then also was looking at this 50 EMA. We had broken above it, and I wanted to, when we were right here, it had started to turn up. I wanted to see it continue turning up and get and be a part of this area of support right here. So I drew a couple lines, arrows, one indicating a pullback here. I mentioned that up in here would not be a buying opportunity as far as I was concerned, but that the next pullback would be, and that is primarily based on the Wyckoff pattern that we saw developing. We went over those points back in here. I mentioned that right here is Wyckoff's favorite place to go ahead and enter long exposure and make sure that he is completely out of short exposure is when you get this higher low right here, which is a signal of strength. It is point number 12 on schematic number 1 of Wyckoff accumulation. So that's where I got really interested and was really perking up when we made this higher low here. Tyler and I both said that we didn't want to see it fall below that, or else we thought this area of support would break down. So that did hold, and we were able to break through the resistance, the top of the range that was that Wyckoff accumulation zone. When that happens, that gives us the 13th point of the Wyckoff accumulation, and the following pullback is where he is interested in adding. He thinks this is the first spot to go ahead and enter and buy, and then if it progresses as expected with a higher high breaking through resistance and a throwback to retest it for support, that is the next best place to enter. So that's what I mentioned in yesterday's show, is that right here isn't a very interesting spot to buy. But if we do pull back into here, that would be a very interesting opportunity. And I mentioned that I had an order set at 80.20, which was based on this horizontal area of support. Unfortunately, that didn't get filled, but you know, you can't get everyone. So that one I did miss my order there, but was buying this morning when we had this candle right here that came off. Basically looked like the reversal that I was looking for, with breaking above the prior closes. So right here we see that it wicks down and threatens to go below the 9 EMA, but is unable to, just like all these candles are. And then this one closes above. It was the highest close of any of these candles. So right there, I did go ahead and add on a little bit, not as much as I would have if this bid would have been filled. But I was still comfortable seeing this action right in here. When this candle closed around 81.91, I did go ahead and add a little bit to the position. So now what I'm looking for is a continuation. I'm wanting to see price get up to 85.30 to 85.60, and I would like to see that. Looks like in about let's see, 1, 2, 3, maybe 12 to 16 hours, we'll say. So by tomorrow's show, that is what I would like to see. That is based on this swing target here, using the open and this high. That gives us the angle and the amount of return. So enter that here. That's adjusted a little bit because we didn't get all the way back. Originally, I had it starting here. So now that gives us a little higher target and a slightly different time frame. So 85.36 in about 12 to 16 hours would be my target, and is what I would be wanting to see if this is going to, it looks like it's creating a higher high now, and if it does, that's about where I'd expect it to go. And then the following pullback, I would expect to come back to the bottom of this channel. And there is horizontal established resistance in this area that would probably hold on the first test, but if we do create another higher low and then come back to retest this area, at that point I would be expecting it to break out. So for now, again, not thinking that this is a buying opportunity. Right back in here is where that was, and back in here, and as well back in here. So for those who maybe didn't buy in the consolidation and are now wondering what to do, it's time to stay patient and hang tight. If you missed an entry and you passed up on it, or you weren't available for whatever reason, then you don't want to go ahead and chase once the price starts moving away from you, unless that was you had a game plan for that originally, that you wanted to buy once this high got taken out. So that is my analysis for Bitcoin. Anything to add there, Tyler?
That's great stuff. If you could just draw a trend line from the far left, the two peaks, the green and the red, no, even further to the left, right there, and that wick top. It seems like we're slightly below that now. Does that, no, straight across, parallel to the, yeah, there you go. Have we exceeded that yet?
Nope, we haven't, and we haven't quite tested it. So that is at about 83.24, and the highest we've made it on this recent move is 82.97, which is, we could maybe draw another one kind of like this. That looks like where this one kind of petered out. And now it looks like we're breaking through that area. And we see some price action here. So that's definitely an interesting area of resistance. That one right here, just based on this channel, I think we should get through there on this move. Oh man, I hope I didn't forget to turn on screen share. I didn't. Good. Okay. So on this move, I would think that we'd be able to get through here just basically based on this channel. And if we do, this would be the next area of horizontal that I would be looking at based on these candles here.
Great. Yeah, very good. Terrific. Good call. Those that don't know Wyckoff, this is a reason to Google it, start looking at it, because that was textbook. That really worked very well. Great call.
I certainly appreciate it. And that reminds me of one other thing that I wanted to cover before logging off. So one quick second here, pulling up just the regular moving averages instead of the exponential, looking at the 50 and the 200 on the 4-hour chart. And this is actually a great example of why I strongly prefer the exponential moving averages. So the exponential moving averages, they will always cross over after the simple moving averages. And that's a reason why many people like simple moving averages, because it is a bit of a lagging indicator. You need the price to move before the moving averages react. And since that's the case, it's intuitive to many people that using simple moving averages, which will react and cross before the exponential, makes sense. That will get you the signals earlier, which should potentially get better prices. Where I view it differently in the sense that I like the later, it takes more action. It's harder to get across from the exponential moving averages. So therefore, I'm inclined to believe that it should have less fake outs, less false signals, and should be more reliable than the simple moving averages, because it is harder for those to cross over. And this is a perfect example. If I was using simple moving averages, my analysis would have been completely different over the last couple of weeks. And and this shows why. So right here, we fell below the 200 and got a death cross with the 50. So right there, based on my system, that would have signaled that it's time to be fully out of long exposure. And that was actually coming right at the area where I was saying this is the ideal entry based on this higher low here. So this is a great example of why I like the exponential moving averages so much more than the simple. So if we take a look at the difference there, we see that the simple continue to support the price, continue to paint a very clear picture that the 50 is resistance and the 20 is support. And it never got even very close to crossing and providing that false signal. So that is an area, that's the original reason why I started using exponential moving averages, was seeing that how hard it was to get those to cross compared to the simples, and therefore how much more reliable those signals can be expected to be. Since they're more rare and they're harder to happen, they should be more reliable, and that has been my experience. So just wanted to point out how different those exponential and simple moving averages are right now on that 4-hour chart.
Excellent. That's great. Great stuff.
All right. Well, that was sure a pleasure. I really appreciate everything that you went over today. I think that most people aren't going to really understand how much value you provided us with today. You walked us through how to not only beat other money managers and how to beat the rate of return of the indices that they compare themselves to, but also how to look at just beating zero and just beating the absolute rate of return. Many people do not think that it's possible. Most people do not think that it is possible to consistently beat the markets. And Tyler is not only showing you how to do it, he's teaching you how to do it in real time. And that is something that is a once in a lifetime learning opportunity that's being provided right now, and largely at no cost to anybody that's watching. So I think there's so much in today's episode from you that I would definitely recommend going back and rewatching and taking notes and listening to. There's a couple nuggets there that you shared, how you beat the other money managers and the indexes throughout your whole career. And that is tremendously valuable information. There are many people out there who are talking, have disparaging things to say based on Hyperwave and the call that we had about the price returning to $1,000. Everybody wants to talk about how wrecked we must be and anybody who's following us must be. And the reality is that couldn't be further from the truth. Tyler just used everything that he is teaching you, and he beat the market. He beat the pants off the Bitcoin market, buying at the 3,000 range, selling well into the 5-figure range, and now buying back well cheaper than he sold. He beat the market. That is nothing but a huge success. And not only did he beat the market, he beat almost every competitor. Anybody else who is trying to trade in Bitcoin, very few are beating the market, and very few beat it to the degree that Tyler did. So I just wanted to express my gratitude for everything that you're teaching us, and again, for having me on today.
Very kind. Thank you very much. And thanks for all of your great observations on the technical side of things. I learn from you every day also. Thank you, everybody. And just one quick word. This is an educational channel. That's what it's here for. We're not pushing anything, except we do charge for some of our webinars and workshops, but believe me, they are worth it. From my point of view, they take many hours to put together, and then many hours to deliver. But even without that, what Leah and I have tried to do for the last year and a half is to present you with different ways of looking at things that people in finance seem to have fallen into a slump, repetition of very simple ideas that just don't work most of the time. And to the extent that anybody can learn from these, that's what they're here for. So thank you all very much, and thank you, Socrates.
My pleasure. Thank you.